Hello and welcome. Many times, less experienced tax professionals will nod knowingly when their more senior colleagues describe a business cost as being either above the line or below the line. But they get that deer in the headlight look when the senior partner suddenly turns to them and asks which it is. In today's episode, we'll prepare you to answer that inevitable question with ease. Well, to answer it anyway. Doing so requires a very brief tour of the corporate tax return so we can identify that mystical line once and for all. Let's start by looking at the tax return of an incorporated business on Form 1120. The basic structure of the Form 1120 starts with the company's gross receipts or sales. That's pretty self explanatory. From this, you subtract your cost of goods sold, or COGS. COGS means exactly what it says. It's the total costs that you incurred to acquire the goods that you sold to your customers this year. The production costs related to the actual goods you sold if you're a manufacturer, or if you resell goods made by others, then whatever you paid to purchase the goods you sold this year, plus a portion of your overhead and other things that the tax code says you have to include in the costs of your inventory. Once we reduce our total receipts by our COGS, we add in other types of income, including dividends, interest income, rents, royalties, capital gains, and other taxable items. The result is our total income. Draw a big line underneath total income. We'll talk about why in a minute. From your total income, you now deduct the various types of business expenses we talked about in episode 12. For example, wages unrelated to production, bad debts, deductions for interest and taxes, charitable contributions, advertising, and any other business expenses that make it through all the hoops we talked about in our prior discussion of business expenses. We also get to subtract certain business losses from prior tax years that, for various reasons, we were not able to deduct earlier and that we've carried over to this year. Our net operating loss, or NOL, carryovers. Once we've subtracted from our total income our allowable business deductions and any NOL carryovers, we end up with our taxable income. We multiply taxable income by our tax rate to come up with our total tax. Normally, that's the amount we would write a check for. But before we do that, we get to subtract payments we've already made, such as the estimated taxes we've paid earlier in the year, and our tax credits, which we'll discuss in a separate episode. The remaining amount is what you owe the government this year. Let's go back to that line I asked you to draw beneath your total income. Remember, you need to answer your senior partner's question about whether a particular item is an above the line or below the line item. Well, this is the line that answers that question. Adjustments that you make to your gross receipts to compute your total income, mainly COGS, are a business's above the line adjustments, and amounts that you subtract from your total income, mainly the common business expenses we discussed before, are a business's below the line deductions. So when someone talks about above the line or below the line, here's the line. Why does this matter? Well, it goes back to our earlier discussion in which we said that constitutionally, Congress can tax you only on accretions to your wealth, and that you're entitled to recover previously taxed money without paying tax on it again. In a sense, the inventory you purchase using previously taxed cash is an investment, the same way as a building or stock that you hope to sell for a profit. The amounts you spend to produce or purchase your inventory is sort of like your tax basis in a building or in stock. You get to recover your COGS tax free when you sell the inventory for the same reason you get to recover your tax basis when you sell the building. In both cases, you've just converted your previously taxed earnings into another type of asset, and you're entitled to get it back without paying tax on it again when you convert it back into cash by selling the merchandise or the building. You only pay tax on any additional cash that you receive in excess of your COGS or your tax basis, your profit. So, like recovered tax basis, COGS is not a deduction from your total income. Instead, it shields a portion of your gross receipts from ever becoming income to begin with. We also said in an earlier episode that deductions for business expenses are a matter of legislative grace, and that Congress can decide whether and how much of a deduction they want to permit for specific types of costs. So, for example, Congress makes some below the line deductions available only to small businesses, and those deductions start phasing out and becoming less valuable or disappear altogether as a company's income or size increases. Constitutionally, Congress is unable to place restrictions like these on your above the line adjustments. But you also pay ordinary expenses using money you've already paid tax on, so what's the difference? Well, the difference is subtle but important. In the case of COGS, you're converting one asset, cash you've already paid tax on, into a different type of asset of the same value, merchandise, which you hope to eventually turn back into cash by selling it. It's your own asset that you just keep converting from one form into another. Just as with your tax basis in a building or stock, cost of goods sold is simply the tracking mechanism to make sure you don't get taxed again on money that is already yours. With a business expense, you aren't converting cash into another asset. You're just consuming it on advertising, utilities, meals, some sort of service, or something like that. You hope that your advertising costs will produce revenue for your business, but normally there's not an asset created when you pay your ad agency, so you don't have any tax basis to recover. You just claim an immediate below the line deduction for the amount you spent. So that's the real distinction between above the line and below the line adjustments. They both generally have the same effect in terms of computing your actual tax bill, but where COGS shields a portion of your gross receipts from ever becoming part of your total income at all, it never even reaches the line. A deduction just affects the ultimate amount of tax you'll have to pay on the remaining gross receipts that do end up in taxable income. So when that senior partner asks if something is an above the line or below the line adjustment, just remember that the line is your total income. And if what you're paying looks like a production or acquisition cost of something you hold for sale, it likely is above the line. But if it looks like an ordinary expense deduction, like advertising costs or bad debts, then it likely is below the line. Well, that's it for now. And as always, don't forget to like, share, and subscribe, and keep checking back for more.